Uh, Thank you, everyone, and welcome to FOF. It's been a while since we had a session. So, Ronak and Raj have presented, and my session was delayed a bit. So, I've been sporadic in the last 1 year. So, uh, like cricket, sometimes the scoring rate is very fast. So, I uh, put forth 5 6 presentations at one go, and sometimes it's very slow. So this is the slow patch. So a lot of people have been asking for some sort of a view, and not from the point of view of market timing, but where do we see things, how things have panned out, and how do we see the way going forward. And the objective today is not to give too many precise answers, but at least try to get some perspective or some context. And there are a few slides that I have which we'll go through, and then we can discuss whatever is there on the minds of people on the call. So this is Nifty uh, from just one moment. From, let's say, around 12,000 levels pre-COVID, it crashed to whatever 7,500, and again bounced back to 15,000. So almost, or actually a doubling from the absolute lows that we saw post-pandemic. So it's been a crazy ride. Most people did not anticipate such a rapid and steep fall, and neither did people expect such a steep rise, and it's left investors perplexed. So typically people do financial analysis, try to estimate demand, uh, get some outlook, and build a portfolio. But a scenario where entire country or entire world is shut down and people are locked into their homes, how do you account for such a situation? How do you even make sense, and how do you even try to make investment decisions in such an environment? So that was not the only crazy thing. Of course, we all know the commodity market went crazy. So crude oil in the US markets traded at a negative price because there was so much supply, and there was not enough storage capacity on the expiration date. So uh, you had to pay people to take crude oil off you on that particular day. And from a negative price, it's back to highs, meaning late 50s or $60, depending on which crude type. We've seen short squeezes by retail investors, people who are coordinating on social media and who are playing havoc with investment professionals who and hedge fund guys who are short, and they coordinate a short squeeze and things like that. Uh, Cryptocurrencies have been having a crazy run. I don't need to tell you all of that. So it's a year where uh, Robin Hood, instead of a character that we read in a story, became an app, and which gamified the act of buying and selling stocks or other things. Uh, Terminologies like SPACs and blank check companies uh, became mainstream. Elon Musk has been there, Trump, all these things have been there in the last 12 months. And yeah, it's difficult to make sense of what is going on. So if one has to encapsulate a period of last 12 months in just two pictures, and from the popular Netflix series, uh, equity investors were like this in the month of March 2020. मैं नहीं बचेगा इधर, मर जाएगा मैं. And the same Ganesh Gaitonde today is कभी कभी लगता है अपन ही भगवान है, meaning the uh, market and investors have been manic depressive. So uh, in month of March, you had some guys who were saying we should shut down the markets, meaning it's so volatile and investors will end up losing money in this kind of volatility. From that period to right now, where things are on the upside. So I think more than anything else, more than markets or more than macros, I think the important thing that last 12 months taught us is that keeping sanity intact has been a key factor. So if you panicked in the early fall and uh, if you get into some of the frothiest things that are around today, you would have done a huge amount of damage to your financial position. And conversely, if you kept calm in March 2020, April 2020, either you did nothing, you stuck to your asset allocation, or if you had some liquidity and at the March lows or even slightly higher in April, you invested some money, and now if you are sitting comfortable, not doing much, not participating in frenzy, you would have been better than most investors out there. And this was not really about great analytical skills or being a visionary in terms of how business trends are going or what macro is going to do, but it's basically behavioral finance, or as uh, on one of the pillars in our office, we have this quote of Parag Bhai, uh, which says that equanimity and not genius leads to uh, wealth creation for investors. So it's really about that, about keeping sanity and equanimity in the last 12 months. I think the and again, this may seem like I'm giving gyan or I'm preaching, and I've been guilty of some of these things. So it's not that Ronak Raj or I or we at PPFS are immune to all of this stimuli. It's just that if you, even if you can't completely avoid all of the stimuli, just reducing the amount of stimuli that washes over will help you make calmer decisions, will help you make wiser investment decisions. So the last 12 months, we've just recap we have just recapped the last 12 months. The question that keeps getting asked very frequently now is, are we in a bubble today? And forget about the last 12 months, what should we do now? So the strange part about people asking this question, what do we do now, to people who are supposed to answer this question, the strangest part is that the person who's making forecasts for the next 12 months did not get any answer right for the last 12 months. So all the people pontificating on social media or on TV channels or in newspaper articles, they confidently claim this will happen in 3 months, 6 months, 12 months, V shape, K shape, W shape, U shape, all kinds of shapes. But did any of them know what is going to happen in last 12 months? Most likely the answer is no. So some people were very, very pessimistic. Those pessimistic people got the extent of trouble from the disease right, but they got the financial market reaction wrong. Some people who were optimistic saying, okay, this is a buying opportunity, they turned out to be right in the financial markets, but uh, most people who were buying at that time thought it's a 3 month, 6 month problem. They never envisaged that it could be, we could have lockdowns as long as a year and a half kind of thing. So, firstly, the prediction is futile, and again, whatever I am going to discuss from now on is more of trying to give context rather than make firm predictions for the future. So this is something which gets talked about uh, quite a lot. So this is maybe a week or two. 12th Feb was when I uh, took the screenshot. So price earning ratio, people talk about 40, 41, 42, whatever is the number. Price to book is high, dividend yield is low. So are we in a bubble? This is one question. So Sensex 35, 36, 3.5. So again, there is some quibble about standalone data versus consolidated data and things like that. But net, people are worried about elevated valuation levels. So people are worried about price earning ratios being too high in the market, and uh, that drives a lot of discussion. So what do we do about it? So before we answer that, let's think about this question. While crossing a river, if we know that the river is on an average 3.5 feet deep, can we drown in that river if people have a minimum height of, let's say, 5 feet? The answer obviously is yes, because average doesn't mean much. At some places it could be 10 feet deep, in some places it could be just uh, 6 inches deep. So you can obviously drown in a river which is on an average 3.5 feet deep. So the index P ratio is relevant if you are buying a index fund, and uh, I don't have so we don't run the sell side kind of research team which forecasts Sensex EPS or Nifty EPS for FY 22 and 23 and so on, and then try to make sense whether market is cheap or expensive. But and so I don't have a very strong view on the Nifty or Sensex valuations, but I'll broadly delve into this with some examples, or try to give some context to the reported P numbers that are there. Uh, so the price is known to everyone with precision. We can know the price by refreshing our Money Control or Yahoo Finance or Google Finance sheets. The difficulty is what is the denominator, what is E. Now, E also may seem to be precise if one is looking at trailing 12 months earnings. Forward looking, it's subject to uh, analysts' behavioral anomalies. So, uh, let's look at E in context. This is where the uh, interesting part is. So, price is known, the Nifty levels are known, the individual stock prices of, let's say, Reliance, TCS, SBI, all these are known with precision. The reason why I don't put too much trust currently in the reported PE is that we are in the pandemic year. The financial year 2021 is a pandemic year. Now, looking back, the June quarter, almost everything was shut down, meaning if uh, people were not allowed to step out of the house, how can you use that quarter's earnings to make any kind of estimation? Again, for some people, the lockdown lasted even later. So, let's say hospitality, movie theaters, these kind of businesses had adverse impact even in December, whereas some people saw pent up demand and saw exceptional uh, results in December quarter. Uh, Banks, NBFCs, they've seen huge amount of loan losses. Now these are not normal loan losses, so it comes once in a while, but you cannot value a bank or a finance company based on just one bad year where, because of some natural calamity, earnings were depressed. You have to value them on a sustainable earnings basis. So this again is not a normal situation. Again, discretionary consumption items, some items have seen a big uptick in demand. Most have seen uh, almost flat demand or negative demand. So again, this is not normal. The margins again are not normal either on the positive side or on the negative side. So some people may see increased costs on account of the lockdown kind of scenario. Other people may have saved a lot of uh, money. So let's say IT companies are not traveling and they are able to make sales on Zoom calls, or a lot of the new recruits may be for now working from home, and they would be saving on real estate costs. So again, the margins are not realistic of a normal scenario. So the biggest uh, confusion item is what is the denominator, what is the sustainable earning for a company or for the market in general. And the other thing is that again, for those who have not seen or heard this, uh, Mr. Charlie Munger had his Daily Journal Corporation's annual meeting just yesterday night, and the video is out in on YouTube. So I would urge you to watch it. And he says that it's obvious that when interest rates are extremely low, the price earning multiples will be elevated. There's no question about it. So it may not be a great time to buy, but uh, it may not be a good idea to sell stocks and uh, stay in money market. And I'm paraphrasing here, but uh, that's the kind of response almost all investment professionals have. So obviously interest rates have been very low. These are the government bond yields where we are close to the lows that we have seen over a period of time. And the other thing that I want to point out, when people talk about bubble, is that firstly, even if it's a bubble, you don't know whether it will inflate further. It could go up 2x, 3x, 4x from here and then burst, or it could generally deflate, meaning gradually come down. The There could be time correction, so prices could stay here for a while. So you don't know the future direction of stock prices, even if you are able to meaningfully answer the question, is there bubble or no bubble? So what should one do if there is so much confusion and if there's so much uncertainty? Uh, Before answering the in the current context, I'll take you back to the period from 1st January, roughly 1st Jan 2008, uh, to next 3 years, let's say 31st December 2010. So 2008, 2009 and 2010, 3-year period. Now, most of you would recall that late 2007, early 2008 was the peak of the bull market at that point in time. And then there was a crash, global financial crisis, and there was a big crash in the equity market. So one would expect that the roughly the 3-year period from that date would be a tough period for investor portfolios. And uh, most people would expect that it would be very important to make a forecast on 1st Jan 2008 to figure out whether we are in a bubble or not. As it turns out, you don't need to be that precise with your forecast, and there are ways of managing equity investments without getting the macro too correct. So let's look at this chart. The uh, bottom graph on the screen, the blue line, dark blue line, is the movement of Nifty. So Nifty fell almost 60% from where it was, and then it ended the 3-year period with a negative 22% return. This is from early Jan 2008 to end December 2010, 3-year period. In that same period, ITC, Infosys, and Sun Pharma gave positive returns of, sorry, Infosys gave a positive return of 46%, Sun Pharma gave a positive return of 32%, and ITC gave a positive return of 14%. And why these three companies in particular? So, if you recollect, the frenzy in 2007 was in real estate, infrastructure, and commodity companies. So, all the iron ore and steel companies were uh, in fashion, all the DLF Unitex were in fashion, all the Lanco, GMR, GVKs were in fashion. Whereas no one wanted FMCG, uh, IT companies, or pharma companies in that period. And these companies did reasonably okay. So, of course, in the crash, some of them fell maybe 25-30%. Not all of them fell, in fact, but they were reasonably resilient even in a downturn. And for the same period, let's look at some other set of companies. So, index fell around 21-22%. Uh, Unitech fell, I think, 82%. DLF fell 63%, and GMR fell 35% after 3 years. So even if you did not get the macro direction right, as long as you stayed away from the frothiest companies at that point in time, and you stayed with reasonably decent quality, uh, well managed companies at reasonable valuations, you were fine. And companies with either leverage or companies with uh, maybe excessive valuations, you lost maximum amount of money in those spaces. So coming back to today, is there a bubble? Can the bubble continue? When the bubble will burst? We have no answers to that. But is there froth in the market? I think answer is clearly yes. We have seen the kind of things happening in SPACs, in Tesla, in GameStop, and all of that. Meaning all the signs of frothiness are there, and we know which are the uh, frothiest areas, right? So meaning, uh, just as a random example, the EV space in US is very, very frothy. The new tech space in the US, where uh, startups with zero earnings, or in some cases zero revenue, also forget net profits. So in some cases they don't even have revenue. Their product will come out in 2 or 3 years, and they are putting at sky high valuations. So obviously there are areas of froth. There are these uh, blank check companies, or so-called SPACs, where people raise money without telling the investors what they are raising the money for. So the listed company will then acquire or merge with some other company, but people putting in money don't have clarity which that company will be, what will be the valuation, and things like that. So uh, Munger had a interesting comment on this. He said that uh, investment bankers will sell shit if shit can be sold. And pardon the language, but this is the exact terminology that Munger used yesterday. So this is the kind of thing which is happening. As long as we don't participate in frenzy, as long as we go through our portfolio line by line with hand on the heart, saying I'm comfortable owning this business at the current valuation for the next 5-7 years, and there are no problems of excessive leverage, the management quality is good, the valuation is not unreasonably expensive, it may be slightly elevated because of low interest rates, then broadly you should be fine. I don't think one should worry too much about markets being at all-time highs, or the other kind of excesses that are happening in the marketplace. So our attempt should be to identify the uh, Asian Paints or the ITCs, Nestle's of 2008, uh, today, meaning which are the companies which will survive the next 5 years, which will not derate in terms of valuation, and which will give you a reasonable total shareholder return in the coming years, and to stay away from the uh, infra, real estate, commodity kind of frenzy area of 2007 and 8, and even today stay away from the frenzied sectors. So again, I'm just giving an example of uh, how one can think about it, or why it's not a good idea to paint everything with the same brush. And don't worry about the name of the company. So let's call it a unnamed company. This company, let's say, has a market cap of 70,000 to 71,000 crores, dividend yield of 2.5%, ROC 27.2%, ROE of 22%. So it's not a bad business, at least on the face of it. Uh, it doesn't have very low ROE or very low ROC. Stock PE looks somewhat expensive, obviously not at the 40 kind of levels, but stock PE looks reasonable. So now let's dive deeper into this company. These are the quarterly numbers for this company. So let's look at this company. So profit uh, before tax in June 2018 was 1,363 crores. In December 2020, it was 1,364 crores, almost the same level as 2.5 years back, right? Now let's look at June 2020 quarter for the same company. June 2020, the company made a profit before tax of just 78 crores. And I don't think we need to be geniuses to figure out why June 2020 was bad. Most likely the thing was because of the lockdown, or there could be some industry specific factors, but let's just take this as a representative company. I think June quarter was definitely terrible. September also would have had some impact, but December seems somewhat normal. So these are the quarterly numbers. So obviously you cannot take the trailing 12 months earnings to figure out the PE ratio. Let's look at the annual profits now. Now in 2014, it made a profit of 2864 before tax, 2100 after tax. The peak profits were in March 18, where it made 3,720 crores of net profit after tax. And profit before tax was 5,104 crores. Now, let's look back at December quarter. December, they made a profit of around 1,000 crores. Now, peak profit in March 2018 was 3,720 crores. Is it too much of a too much of a stretch to say that this company can make 4,000 or 4,500 crore sustainable profit uh, on an annual basis? I think it can make. Again, if we look at the interest cost, it doesn't have much interest cost. It has plenty of other income, which is indicative of this company being cash rich company. I don't think there's too much debt on the balance sheet. In fact, there's surplus cash on the balance sheet, and ROC, ROE, etc. seem reasonably okay. So now for a company which is expected to make, let's say, 4,500 crore profit in a normal kind of environment, a market cap of 70,000 crores, some people may say cheap, not cheap, depending on the name of the company, industry outlook, etc. But definitely you cannot argue that we are in a bubble kind of scenario. And this is just a representative company. It's not that uh, I'm harping on one particular company. In the marketplace, if you go stock by stock, line by line, you'll find companies where you can with reasonable certainty uh, make an investment decision and say, okay, I'll buy this company, stay invested for 5 years, 7 years, and see what happens. The management is decent, the uh, COVID situation is improving globally and in India with vaccines, or overall, again, a few months back, things were scary, but things are gradually improving, and we can see light at the end of the tunnel, and we can see some sort of a normalcy coming in the day-to-day lives of people as well as the economic environment. So, just going by Nifty PE or Sensex PE and saying, "Oh, I'll liquidate everything and I'll put money in my savings bank account or liquid fund with and earn 3% and then wait for a correction and then buy." I don't think it will work. And this is experience from my interactions with clients. In March 2020, I had a conversation with a client. Client said, "What is your view?" I said, "I don't know what will happen to the COVID situation, but uh, diseases come and go. You cannot liquidate all your investments or uh, play around with your asset allocation just based on what will happen. Stay invested and we'll ride it through whatever happens. I don't know the timeline and things like that. Uh, we are comfortable with the companies that we own." Uh, he said, "Okay, I respect your view, but I'm scared. Let me sell my portfolio." That person liquidated all his equity investments in March 2020, uh, just at the beginning of the crash, meaning it had already fallen about 10-15%. But after he sold, it seemed like a great decision because market crashed further. So that person was feeling very happy. Now, on the way up, each rise seemed like a fake rise, meaning, oh, this is a temporary thing, it'll crash again. Nothing is going to happen. It'll crash again. I'll not buy. I'll not buy. And that person is still sitting on cash till date. There's another client who held through the crash, but the moment the prices started touching the February levels, he said, "Oh, we are back to almost pre-COVID levels, and obviously economy is damaged. So I think things are a bit extended. Let me sell now, and I'll buy when market dips." And now that person again is still waiting. Money is in the liquid fund account, earning 3% interest, and waiting. Now, whether that will turn out to be a correct decision, not correct decision, who knows? But at least so far, it doesn't seem to be such a great idea to uh, just try to predict things and try to tinker around with your basic goals and basic asset allocations. And finally, don't forget that massive amounts of monetary stimulus is there, interest rates are low, government spending is uh, at elevated levels. In fact, the latest stimulus, which uh, will be maybe 1.5 to $2 trillion in the US, is still to happen. Uh, a lot of reform measures have happened. Some amount of protection is being given to domestic industry, PLI schemes, scrappage policies, all these things are there. For the first time, government has openly mentioned the word privatization multiple times in the budget. Uh, a lot of pent up demand is there because people would have money in their bank accounts where spending would not have happened. In the tough time, a lot of tough decisions got taken. So, uh, recently I was listening to a call of a business group, which is otherwise well run, but they had sprawled all over the place. So they had gotten into multiple business lines. They had uh, foreign subsidiaries, and they were all over the place. So the uh, shareholder returns and return on capital was extremely poor. Now they have taken tough decisions. They've said a foreign subsidiary, if it's not working, let it go into bankruptcy. We'll not continuously keep putting in money there, and tough decisions have been taken. So wherever cost cuts have had to happen, people have taken those decisions. So uh, one has to realize that the margins for corporate India have been at historical lows, even pre-COVID. So companies have tightened their belts and improved their uh, performances, and a lot of spring cleaning is happening. As I mentioned, a lot of divestments, mergers, and cleaning up of the overall balance sheets is happening. Also, a lot of players have exited. So most vivid example we see is in telecom, where now we are left with three large private players. In, let's say, uh, home loan segment, now a lot of new entrants had come in, or a lot of players like, let's say, DHFL, etc., were there. Now a lot of players have exited the marketplace. Now with all these exits, what it does is that the competition reduces, and market share gains are there. So that brings in operating leverage. The pricing power is there with the business. People can take some amount of price hikes, whether it's interest rates, or whether it's telecom pricing, or any other business. And also competition for talent reduces. So you don't have to worry about uh, your people being poached away and things like that. So a lot of these positive factors are also there. So don't just stick to the uh, gloomy environment of the last 12 months, and don't uh, just go by the crazy things that are happening in the world and say, just because there is craziness in a lot of pockets that I can see, everything is in a bubble, and let me sell all my equity holdings. That would be a very drastic step to take. Doesn't mean that there are no risks in the market, and which is always the case. So one has to be aware that inflation is a risk. Uh, if low interest rates are a rationale for uh, higher price earning multiples, as interest rates rise, those multiples could shrink in the future years. So inflation and interest rates, one has to keep watching for. And today governments are spending a lot more money not raising taxes, but somewhere down the road they have to also tighten their belt. Monetary policy is loose in the foreseeable future of 1 to 1.5 years, but down the road you could see some tightening even there. Again, there are no guarantees about monetary tightening, because Japan has had low rates for uh, long period of time. Europe has had low rates for a while, but one has to be wary of these things. So these are the charts of Indian government 10-year bond yields. So while rates are low, we saw that on the longer term price chart, but from the bottom, we have already seen some amount of rate increase. So about 0.5% rate increase is already there, uh, even in India, despite the loose monetary policy of RBI. Surprisingly, uh, the 1 year chart for US 10-year government bond yields, actually rates are higher today than uh, 1 year back, which would be somewhat of a surprise. So from a roughly 0.5% 10-year government bond yield on US treasuries, we have gone up to 1.34%. Uh, so also beware of companies without pricing power. So not all companies will benefit in this environment. So input costs have been going up. So this is a graph of copper prices in dollar terms. This is steel prices in CNY. So net, we all know that input prices are going up. So which is great for primary producers or for companies with pricing power. But if there are weak players who do not have pricing power with their customers, they could actually suffer in such an environment. So lastly, learnings of last 12 months. Firstly is humility, meaning no one gets it right. Now, in Silicon Valley, all these tech billionaires were talking about uh, living forever and doing research in longevity and all that, and a virus out of nowhere, and people couldn't figure out how to tackle that. Again, people made all kinds of forecasts, and most of them turned out to be right. So, firstly, again, Berkshire Hathaway sold their airline shares, and uh, airline companies have gone up significantly from where they sold. So, last 12 months has taught all of us humility, meaning don't take nature for granted or don't take markets for granted, meaning they can uh, throw a lot of surprises. However, if your asset allocation is right, meaning if pre-COVID, if you had enough emergency funds in your liquid fund or in your FDs, and all your uh, long-term money was in equities, uh, which was according to your needs and risk appetite, then you need not have worried in the downturn, and even right now you don't need to do anything. So last 12 months has taught us not to try to time things too much. It has taught us not to have leverage. So people who had leveraged long positions in before the COVID got wiped out in the COVID environment. Uh, People who were short sellers also got wiped out in the recent times. So either because of short squeeze or because of markets running up so much. So don't try to predict things. What matters is you should be prepared for things rather than predict things. You should be prepared for adversity so that your asset allocation is appropriate, your companies are sufficiently robust and things like that. So it's basically brought back the timeless principles rather than uh, trying to act smart at all times. Yeah, so don't panic. I think it's just another day in the investment universe. It's except for the panic on account of health of people, where COVID was such a scary thing. The market up and down has, we have seen this numerous times in the past as well. So uh, there's nothing new here, and one should not panic too much. And net, I think stick with the asset allocation. So I'll stop here, and we'll take questions. Uh, Thank you so much for listening.
Thank you so much, Rajiv. If anybody has any questions, you can unmute yourself and ask it. It's a regular FOF meeting. We'll go with the standard ask your question yourself rather than me reading out the question. I see a question from Mr. Kirit Modi. Sir, please can unmute yourself if you can. If you can't, I can ask your question.
I've seen the question. I think he's asking views on the MMT, modern monetary theory. Uh, so far, governments have been getting away, or central banks have been getting away with printing money, and without having adverse impact in terms of the consumer price inflation and things like that. The only inflation we have seen is in asset prices rather than consumer prices, but doesn't mean this will last forever. We have seen increase in steel, copper, and various uh, input prices. So I am not uh, in the camp of free lunch MMT camp. And again, I would urge you to view the Charlie Munger interview. He was asked the same question, and his views were similar in that sense.
So then, how do you explain, for last 20 years, Japan is doing this and there is no inflation. So what do you, how do you, I'm seeing so much disconnect, so when this, in fact, the interest rate is zero, so the terminal value becomes infinity. So that's one school of thought. Another school of thought, like, Jeremy Grantham and all that they're saying is going to crash. So we are totally confused as to, what we should do.
Sure. So again, when I give an answer for the last 20 years, I'm probably just telling you a story because it's an explanation. Now, whether that is valid or not valid, we cannot test it out. But one of the explanations which I found sensible is that you had this scenario of a lot of manufacturing moving from Western high cost countries to low cost countries like China, and where manufacturing happened at scale. And uh, with Chinese weak currency, the consumer prices did not go up in most countries. So again, just as an example, a random example, let's say the uh, Nokia 5110, which was my first cell phone, was uh, around 10,000 rupees. Now, a much more advanced cell phone today with uh, far greater features and with so much of rupee depreciation still can be bought for roughly the same price if you buy a Android phone. Again, we have seen a lot of disintermediation, and with uh, all technology kind of plays coming in, so uh, earlier the intermediaries could jack up their margins or prices. With price discovery and with e-commerce and transparency, a lot of disintermediation happened, which resulted in subdued inflation. Also, the wage inflation in Western uh, countries was muted because uh, offshoring and outsourcing kind of thing. Now, a lot of these things seem to be reversing. Firstly, the Chinese currency has been appreciating somewhat. The commodity prices have been going up. The political environment is such that there's a anti-China sentiment. There is a strong move to hike the minimum wage rates in Western countries. So if you have been tracking things, there have been demands for a minimum $15 per hour wage rate in the US. uh, we've been having these farmer protests in India where they want more and more MSPs for agri produce. Now, at one end, they give uh, more remuneration to farmers, but at the other end, it will result in higher consumer prices for uh, people who are consumers of these products. So again, the I think I've gone on far too long on this question, and uh, my talk has been far in excess of my competence or knowledge on this subject. The whole point of presentation today was not to worry about things like MMT and things like that, but to focus on individual businesses and individual companies that we own. So yeah, this is probably all I have on this subject.
Hello. I have a question. Can I ask?
Yeah, my love.
Yeah, thanks for the opportunity. Just yesterday, the RBI governor said that, presently they don't have any plans of reducing liquidity in the market. But let's say 4 quarters, 3 quarters, 4 quarters down the line, when inflation remains a problem and when liquidity is, severely chunked out of the system, then what sort of approach will we have as PPFAS, and what sort of sectors would you be bullish on, and would you try and exit from the existing framework? Thank you.
Thanks, my love. So again, going back to the theme of preparing and not predicting, um, liquidity could reduce in 4 quarters, it could reduce in 4 years, or it may not reduce for 10 years. We don't know what will happen. Uh, However, we are not invested in leveraged companies. So, except for uh, some financial exposures, meaning banks and NBFCs, which are in the business of borrowing and lending simultaneously and who do asset liability management, uh, our investee companies are cash rich companies. They have surplus cash on their balance sheet. So if at all rates were to rise, they will benefit from higher other income probably. If inflation goes up, uh, we are trying to invest in companies with pricing power. We are not trying to invest in companies which cannot raise prices. So if we prepare for all these things, and if we stick to the core investment principles, I don't think we need to do anything different or anything extraordinary in the current times. What I'm trying to convey is that it seems that it is very different today, or it seems that we are in a unique time, but uh, this kind of situation happened in late 90s dot-com time. This kind of situation happened in 2007 with real estate commodity infra boom. This thing happened in 2017 with uh, the small and mid cap rally. If you stay away from the frothiest areas, and if you stick to companies, businesses that you understand, and with good quality management, with high ROE, ROC, with very low leverage, limited amount of competition, with pricing power, I think we should be fine.
Just had a small follow-up on this. So, I just wanted, because the answer that you mentioned. So if we look at other companies which are having, let's say pricing power, or sustainable competitive advantages, or sorts of like that, they are available at a very high PE. I mean, if you take a look at companies like Asian Paints or Pidilite or Relaxo, those so-called coffee cans, they are available at a very high valuation. So in such a scenario, if you want to stick to good management or a good company with sustainable competitive advantages, then where should we look for is the new opportunity? Thank you.
So the good part is that many years back, when we started in equity research, uh, this software package Capitaline or Ace Equities was available only to investment professionals. Uh, these days, with online tools like Screener and various other websites, these tools are available to everyone. Now, running a screener on all the listed companies in India, put parameters that you want. Let's say if you want a minimum uh, ROC of 15%, then put that as a criteria, minimum ROC of 15%. You don't want uh, debt equity more than 0.25 or 0.5. Put that as a criteria in your screen. Run a screener. Uh, you will get a list of all the companies. Then you will see which are the expensive ones. Obviously, there'll be the companies that you named, Asian Paints, Pidilite, and Nestle, and so on, which you said are looking expensive. But then look at other companies in that screening list. Are there companies which are having decent financials, where the management has a long track record, and where the valuations are not so expensive? So these tools are very easily available. So I take your point. There are, in every market, there will be great companies which will be very, very expensive. And in every market, there'll be great companies which people are not focused on. So in late 90s, Wipro uh, was a great company. Wipro is a great company today. So in 99, if you had asked me, oh, Wipro is a great company, but it is quoting at a very expensive valuation, you are correct. But no one is forcing you to buy Wipro. You could have bought an old economy, so-called old economy share at that point in time. Uh, Same way, in 2007, you could have said, oh, I see a great future for real estate in India, but I think DLF is very expensive at this point in time. You would be right, but then no one is forcing you to buy DLF in 2007. You could have bought Wipro and Infosys in 2007. The time to buy Wipro and Infosys was not in 1999 or early 2000. The time to buy Infosys and Wipro was in 2007. So look at the sectors and areas which are ignored and run a screener, meaning it's as simple as going to a website and just playing around. There's nothing more complicated than that.
Okay. Thank you. Thank you very much.
Any more questions?
Ronak, there is one question on the chat box. Someone is asking Rajiv's view on insurance sector and why our portfolio doesn't have such companies.
Sure. So in India, our either number one or number two holding is Bajaj Holding, which is a play on insurance. So Bajaj Holding has two components. Let's say, without getting into too much precision, half is Bajaj Auto, half is financial services. So Bajaj FinServ is uh, life and general insurance plus Bajaj Finance. So we have exposure to insurance companies via Bajaj Holding. We own ICICI Bank, which again owns ICICI insurance companies. So standalone insurance companies, they have never really been very cheap or attractive. We felt that it's better to invest in them via the parent companies, but we do have indirect exposure to these.
Hi Rajiv, can you hear me?
Yeah.
One question in your presentation, you said there's a lot of fraud in EVs and startup companies of US, and where there are no earnings, and all your examples of or the companies of US. So do you see any fraud currently in our market, some sectors or something happening which you are not comfortable?
Sure, there are, meaning you look at the top gainers in the last 52 weeks,
Yeah.
look at the list of companies, and you look at whether the company has revenues, whether the company has profits, what is the quality of governance in that company, and you'll find the frothy space. So the momentum investors will blindly buy all of those, and I'm not saying all of those are frothy or all of those are bad, but there are some obvious names where you can see that there's no earning currently, or where the market cap is way too crazy for the business operations, or where the stocks are running only on a created narrative or a story, or where the floating stock is extremely limited, and where by a few people doing volumes the stock price goes up. So clearly, even in India, there are areas where there is fraud.
And second question would be, what's your view on the capex cycle, which which is not coming for many years now? Again, we are as a market participant all are hoping this capex cycle is coming soon. That's what reflected in the price and also in a few commentaries. What is your thought on the capex cycle? If any of you, Raj, Ronak, or Raj, you can take it. Yeah.
Sure, I'll try and answer that, and invite Ronak and Raj to share their views. So our preference is for asset light businesses. So we are happy if our companies don't incur too much capex and still grow profits. So that is our first choice. But we are seeing signs even in our company. So one of our portfolio companies, for example, Balkrishna announced a huge capex. Now, I think market does not like either ways. When companies don't incur capex, people say there's no growth, and what's happening, there's no capex cycle. And when they announced capex, the stock price was hammered down, saying you're doing too much capex. So yeah, as demand comes, people will keep doing capex, and again, sometimes you can optimize things. So a brownfield capacity expansion will not require as much money as a greenfield capacity expansion. Sometimes debottlenecking can also uh, increase capacity. So we are not in the heavy infrastructure led sectors, or those kind of businesses where we are dependent on either government capex cycles, or we are not uh, too much invested in capital good companies like, let's say, BHEL, where we want huge thermal power plants to come in, and we are holding our breath for that to happen. the kind of companies we invest in, we think we should be more or less okay. Ronak, Raj, anything to add?
So a lot of capex happens in unlisted areas also. So we tend to overlook that because the numbers are not visible to us. We don't read the newspaper articles about those companies. But several unlisted companies can also see investments, and some subsidiaries of MNC companies who are investing. So one area where capex happens quite substantially is in the data center space. Or if you see government infrastructure that is happening everywhere, they're building roads, they're completing projects, metros are coming up. So a lot of capex around us is happening. It may or may not directly benefit companies which are listed. So that's the sad part. We wish everything is listed and we can benefit out of that. But a lot of unlisted companies also do merit look if you want to see capex cycles happening.
Yeah, just to add what Ronak said, so given that low capital intensity is very famous right now, so most of the listed companies don't want to incur capex. So outsourcing has become a big trend with most of the sectors that you see. So barring infrastructure and real estate and some other sectors, most of the sectors are now doing outsourcing. So outsourcing happens to smaller companies or unlisted companies. So that is also a trend which is seen.
Yeah, and if we just look around us, meaning as Ronak mentioned, so much of metro rail in our city, coastal road, all the bridges are happening. Steel prices have gone up, cement prices have gone up, real estate sales in Q4 of 2020 were quite high with the stamp duty cuts in Maharashtra, and even elsewhere they were higher. So, meaning investment and investment and spending has increased, whether at the end consumer level, government level, or as Raj mentioned, in some cases it may be with the ancillary suppliers to the large companies where capex may be happening. Again, down the road, I think as people move from internal combustion engine to electric vehicles, that whole capex cycle has to come sooner rather than later in terms of battery capacity or in terms of rejigging the production facilities. As wind and solar becomes more prevalent, a huge capex cycle will happen in the renewable energy space, and whether downstream that results in some kind of storage related capex, that also is a possibility. So I am not so worried about capex not being there. It will be there. The only thing is we should not overshoot on the other side. So post the global financial crisis, we loosened up so much and all sorts of capexes and capacity expansions happened, and then there were bad loans with the financial sector and things like that. At least at this stage, I don't think the worry is that demand will not be there because of lack of capex. If there are no more questions, we can wind up.
Yeah, we can stop the official part of the meeting, and if people want to just hang around and chat, we can continue with that. So I'm stopping the recording, and thanks Raju for the nice presentation. Thanks for the good questions. Thanks everyone for attending and missing the test match. I don't know if you have two screens going on, but yeah. Thanks so much.
Whenever things got rough, I always remember what my father used to say.
Running a business does test a man, my son. There are ups and downs, glorious highs, and sometimes a low that leaves you feeling defeated.
The character of a man and the character of a business are not very different, are they?
Yes. But when the chips are down, we must stand up, dust ourselves off, and motor on.
Volatility. It's a funny thing. It makes you question yourself and wonder if you've made all the right decisions.
Sure, you can question some of your decisions, But stay steadfast on your goals.
Dad always said, there are no shortcuts and no quick profits.
There are no free lunches, are there? There is only one
Right way.
At PPFAS, we think like Rahul and his father. That volatility is a fact of running a business. And buying equity shares is like owning a part of that business. We use value investing principles to manage your money. This means we invest in the right businesses at reasonable prices and for a longer term.
PPFAS Mutual Fund. There's only one right way. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.